Every single day, the United States government holds an auction, not for art or antiques, but for something far more valuable: promises to repay borrowed money. These auctions happen so routinely that barely anyone notices them. Investors from around the globe show up, virtually of course, and hand over their cash in exchange for U.S. Treasury securities. It has been this way for decades. But here is the uncomfortable question nobody wants to ask. What happens when those investors stop showing up? I am not talking about a temporary dip or a bad week. I am talking about a fundamental shift where foreign nations, the ones currently holding over $7.5 trillion in American government debt, decide they are done. They stop buying new bonds. They let their existing holdings mature without replacing them. Some might even start selling. This is not science fiction. The mechanics that could trigger this scenario are already visible if you know where to look. And understanding what would follow is not just academically interesting, it could determine whether your retirement savings survive, whether you can afford a home, or whether the global economy remains recognizable. Let me take you through this, step by step. Before we explore the collapse, we need to understand why this system exists in the first place. When you hear that China holds over $1 trillion in United States debt, you might picture it as some kind of leverage or weapon. That is not quite right. The reality is more practical and in some ways more mundane. Foreign governments accumulate dollars naturally through trade. When a Chinese company exports goods to the United States, it gets paid in United States currency. That company converts those dollars into yuan through China's banking system, which means the Chinese central bank ends up holding massive reserves of dollars. Now, you cannot just stuff $1 trillion under a mattress. That money needs to go somewhere. United States Treasury bonds have been the obvious choice for generations. They are considered nearly risk-free. They are incredibly liquid, meaning you can buy or sell them quickly. And they pay interest, even if it is modest. For a central bank managing a nation's reserves, treasuries have been the global safe deposit box. There is also the structural reality of the dollar's role in international commerce. When Brazil buys oil from Saudi Arabia, that transaction often happens in dollars, not reals or reals. When a European company invests in Southeast Asia, dollars facilitate the deal. This creates a constant global demand for United States currency, and those dollars need a home. The American government has benefited enormously from this arrangement. Because demand for U.S. Treasury bonds is so high, the USA can borrow at lower interest rates than it otherwise could. A family with excellent credit can get a better mortgage rate than someone with a spotty history, and the same principle applies to countries. This system has created what economists call a virtuous cycle. Investors trust USA Treasury bonds, so they buy them. That demand keeps interest rates low. Low rates make it easier for America to service its debt. That reliability reinforces investor confidence. Round and round it goes, until it doesn't. Several trends are quietly undermining the foundations of this system. First, the sheer scale of U.S. borrowing has accelerated. The national debt now exceeds $34 trillion. Annual deficits regularly top $1 trillion. To fund these deficits, the Treasury Department must constantly issue new bonds, while also refinancing older debt that is maturing. The volume of bonds flooding the market has grown substantially. Second, geopolitics are shifting. The post-World War II order that made American economic dominance seem permanent is fraying. Countries are increasingly thinking about reducing their dependence on dollar-based systems, whether due to concerns about sanctions, currency diversification, or simply changing power dynamics. Third, alternatives are emerging. While no currency truly rivals the dollar yet, the menu of choices is expanding. The euro exists as a major reserve currency. China has been pushing to internationalize the yuan. Digital currencies and new payment systems are creating pathways that bypass traditional dollar infrastructure. Fourth, creditor nations are changing in ways that matter. Japan, the largest foreign holder of U.S. debt, has an aging population and may eventually need to liquidate foreign assets to support retirees. China's economic model is evolving, potentially reducing its trade surplus and therefore its dollar accumulation. Any one of these factors alone might be manageable. Together, they create vulnerability. The trigger does not have to be dramatic. It could be gradual, a slow shift in central bank reserve allocation strategies. Or it could be sudden, a geopolitical crisis that makes holding United States assets seem risky or undesirable. Either way, once the tide turns, the consequences cascade through the entire financial architecture. Picture a marketplace where everyone suddenly wants to exit at once, but the doors are not big enough. The Treasury market operates with remarkable efficiency under normal conditions. Trillions of dollars in bonds change hands daily. Banks and financial institutions act as intermediaries, buying bonds from sellers and selling to buyers, keeping the gears turning smoothly. But these intermediaries, called primary dealers, operate with limited capacity. Regulatory requirements enacted after the financial crisis of 2008 restrict how much inventory they can hold. They are like warehouses with strict size limits. When foreign investors begin pulling back, those dealers must absorb the selling pressure. Initially, they can handle it. But if the selling accelerates or simply persists, they hit their limits. At that point, they stop bidding aggressively. Prices fall because there are not enough buyers to match sellers. Here is where bond mechanics become crucial. When bond prices fall, yields rise automatically. They always move in opposite directions. If you buy a bond for 90 cents that pays $1 at maturity, you have a better return than buying it for 95 cents. So foreign selling drives bond prices down and yields up. Higher yields mean higher interest rates across the economy because Treasury yields serve as the benchmark for virtually all other borrowing. During March 2020, we witnessed a preview of this dynamic. The Treasury market, supposedly the safest and most liquid in the world, seized up. Investors could not sell bonds without accepting massive losses. The Federal Reserve had to intervene with unprecedented emergency purchases, hundreds of billions of dollars, to restore basic market functioning. That crisis was temporary, driven by pandemic panic. But imagine if the selling pressure were permanent. Imagine if month after month, foreign central banks were net sellers and domestic buyers could not absorb the volume. The Federal Reserve would face an agonizing choice: step in to buy bonds on a massive ongoing basis or allow market dysfunction to spiral. The immediate visible consequence of sustained foreign selling would be surging interest rates. Let's make this concrete. In recent years, the benchmark 10-year Treasury yield has fluctuated between roughly 2% and 5%. Now imagine that yield jumping to 7%, 8%, or even 10%, because buyers demand much higher returns to compensate for increased risk and reduced demand. Every interest rate in the economy would follow that rise. Mortgages would become crushingly expensive. A 30-year mortgage rate that was 6% might hit 9% or 10%. That would transform housing affordability overnight. A family that could afford a $400,000 home at 6% might only qualify for a $280,000 home at 10%. Corporate borrowing costs would skyrocket. Companies that need to refinance existing debt or raise money for expansion would face punishing interest expenses. Many would cancel investment plans. Some would struggle to service existing obligations. Credit card rates, auto loans, and student loans, everything tied to underlying interest rates, would become more expensive. Consumer spending, which drives roughly 70% of the United States economy, would take a severe hit. The federal government itself would feel acute pain. Currently, Uncle Sam pays hundreds of billions of dollars annually in interest on the debt. If rates doubled or tripled, that interest expense would explode, potentially consuming a quarter or more of the entire federal budget. That money cannot go to defense, healthcare, infrastructure, or anything else. This creates a vicious spiral. Higher interest costs increase the deficit. A larger deficit means more borrowing. More borrowing in a skeptical market means even higher rates. The snake eats its tail. Politicians would face impossible choices: slash spending dramatically, raise taxes substantially, or accept an ever-worsening fiscal position. Each option carries enormous political and economic consequences. Banks, insurance companies, pension funds, and other financial institutions hold enormous quantities of United States Treasury securities. These holdings are considered the safest part of their portfolios, the foundation everything else rests on. When interest rates spike and bond prices collapse, those institutions take massive losses. Let's walk through why this matters. Banks must maintain certain capital ratios. They need a cushion of owners' equity relative to their assets. When the value of their Treasury holdings drops sharply, that cushion shrinks. Some banks might fall below regulatory requirements, forcing them to raise capital, sell assets, or curtail lending. Insurance companies make long-term promises to policyholders, and they invest premiums in safe assets to ensure they can pay claims. Steep losses on their Treasury portfolios could threaten their ability to meet obligations. State insurance regulators might need to step in, and policyholders could face uncertainty about whether their coverage is secure. Pension funds face perhaps the most acute challenge. They have promised specific retirement benefits to workers. Those promises are backed by investment portfolios heavily weighted toward bonds, including Treasuries. When bond values plummet, pension funding ratios deteriorate. Retirement security for millions of people suddenly looks shakier. Money market funds, which regular investors often use as cash equivalents, could break the buck, meaning their net asset value drops below $1 per share. This happened in 2008 and triggered panic. Investors would rush to withdraw money, forcing funds to sell assets at fire sale prices, accelerating the downward spiral. The Federal Reserve would likely implement emergency measures, providing loans to struggling institutions, guaranteeing certain types of debt, perhaps even purchasing bank equity stakes, as happened in 2008. These interventions can stabilize the system, but they are politically toxic and economically distortionary. Deposit insurance funds might face claims exceeding their reserves if multiple banks fail. The government would need to backstop the insurance system, adding to fiscal pressures. International financial linkages would transmit stress globally. American banks lend to foreign banks. European institutions hold United States assets. When American financial institutions stumble, the tremors spread worldwide with global consequences. Financial market chaos does not stay confined to trading floors and balance sheets. It spills into Main Street with brutal efficiency. Housing markets would crater. With mortgage rates at punishing levels, buyer demand evaporates. Home prices fall, sometimes precipitously. Construction companies lay off workers. Real estate agents face collapsing incomes. Homeowners who bought recently or refinanced find themselves underwater, owing more than their house is worth. This is not merely unfortunate for individuals. Housing is a massive economic engine. Residential construction, real estate services, home furnishings, appliances, and renovations. Entire sectors depend on a functioning housing market. Business investment would collapse. Why would a company build a new factory or buy expensive equipment when borrowing costs are astronomical and the economic outlook is terrifying? Capital expenditure pulls back sharply, reducing demand for industrial equipment, construction services, and everything else businesses buy when they are expanding. Unemployment rises as companies cut costs. Layoffs spread from construction and finance into manufacturing, retail, services, and beyond. Consumer confidence plummets. People who are worried about losing their jobs do not make big purchases. They hoard cash and cut spending. This creates a negative feedback loop. Reduced spending means businesses earn less revenue. Lower revenue leads to more layoffs. More unemployment means even less spending. The economy spirals downward. State and local governments face budget catastrophes. Their tax revenues decline as economic activity shrinks. At the same time, demand for social services increases as more people need unemployment benefits, food assistance, and healthcare help. Many states have balanced budget requirements, forcing them to cut spending or raise taxes during a recession, exactly when conventional economic wisdom says they should do the opposite. Stock markets would likely crash as investors reassess the value of companies facing higher borrowing costs, lower sales, and bleak prospects. Retirement accounts that millions of Americans depend on would suffer significant losses. Wealth destruction on this scale affects spending patterns even beyond direct unemployment. The psychological impact compounds everything. When people feel scared and uncertain, they behave cautiously. They postpone major decisions. They save rather than spend. This prudent individual behavior becomes collectively devastating when everyone does it simultaneously. For decades, holding dollars and dollar-denominated assets has been essentially mandatory for anyone participating in international commerce. That status has granted America extraordinary privileges. When foreign investors flee U.S. Treasuries, they are implicitly questioning whether they want to hold dollars at all. If Treasury bonds, supposedly the safest dollar asset, seem risky, why hold dollars for any purpose? Treasury bonds would lose their aura of safety. Central banks worldwide would begin restructuring their reserve holdings. Instead of 60% in dollars, they might shift toward 40%, distributing the rest among euros, yen, yuan, gold, and other assets. This diversification reduces global dollar demand. International trade patterns would gradually shift. Countries might increasingly settle transactions in other currencies. Oil sales might happen in euros or yuan rather than exclusively dollars. Trade agreements might specify alternative payment methods to reduce dollar dependence. Trade relations would change. The practical mechanism works like this. When global dollar demand falls, the dollar's exchange value weakens. A weaker dollar makes imports more expensive for Americans. That iPhone assembled in China costs more. A European vacation gets pricier. Gasoline, clothing and electronics, anything with foreign components or foreign origins becomes less affordable. Imports would drive living cost increases. Inflation accelerates through this import price channel. The Federal Reserve might feel compelled to raise interest rates to combat inflation, but rates could already be high from the fiscal crisis. The central bank faces conflicting pressures with no good options. Inflation becomes harder to control. For decades, America has been able to run persistent trade deficits because foreigners have been willing to hold the resulting dollars. If that willingness evaporates, the U.S. would need to balance its trade, meaning importing less or exporting more. Adjusting trade flows of this magnitude does not happen smoothly. It requires painful restructuring of industries and supply chains. Restructuring will be costly. The exorbitant privilege of cheap borrowing would vanish. America would face borrowing costs more typical of other developed nations, or worse if investors perceive elevated risk. Federal budget constraints would become much tighter. The government would have far less fiscal flexibility to respond to crises or fund priorities. Exorbitant privilege would be gone. This does not mean the dollar collapses overnight or loses all international role. Reserve currency status changes slowly, usually over decades, but the trajectory would be clear, and the relative decline would impose real costs on American living standards and policy options. Reserve currency status would be diminished over time. Governments do not sit passively while crises unfold. Policymakers would deploy every tool available to stabilize the situation. But those tools carry their own costs. The Federal Reserve's most direct option is buying Treasury bonds to replace foreign demand, essentially creating money to purchase government debt. This is politically controversial and economically risky. It works in the short term by putting a floor under bond prices and providing liquidity. But sustained, large-scale money creation risks serious inflation. If the Fed buys trillions in bonds over months or years, the money supply expands dramatically. When people notice their dollars buying less, inflation expectations rise, and inflation can become self-fulfilling. Workers demand higher wages. Businesses raise prices. The spiral accelerates. The government could implement financial repression, policies that force domestic institutions to hold Treasury bonds regardless of returns. Regulators could require banks to hold higher percentages of Treasuries, or pension funds could face mandates about government bond allocations. This creates captive demand but distorts financial markets and reduces efficiency. Capital controls might be considered, restrictions on moving money out of the country. This keeps domestic savings trapped in U.S. assets, but frightens investors and damages America's reputation as an open economy. Once imposed, capital controls are hard to remove and signal desperation. Tax increases could reduce deficits, making government finances look more sustainable, but raising taxes during a severe recession deepens the contraction. It is economically painful and politically difficult. Which taxes rise? Who bears the burden? Spending cuts face similar challenges. Slashing government programs during economic crisis increases suffering and worsens the downturn. Defense spending, entitlements like Social Security and Medicare, infrastructure, every choice creates fierce opposition. Some economists might advocate default or restructuring, essentially telling bondholders they will not receive what was promised. This would be catastrophic for America's credibility and would likely be considered only in the most extreme scenario. The political and legal chaos would be immense. International cooperation could help. The Federal Reserve could arrange currency swap lines with other central banks, ensuring dollar liquidity globally. The International Monetary Fund might coordinate some response. But these institutions have limited capacity, and international unity is fragile during crises when every country faces its own problems. Realistically, policymakers would deploy some combination of all these approaches. The Fed would buy bonds while trying to control inflation. Congress would pass some tax increases and spending cuts while protecting favored constituencies. Regulators would nudge financial institutions toward government debt. It would be messy, contested, and only partially effective. The United States remains the world's largest economy and the center of the global financial system. When America suffers a crisis of this magnitude, nowhere escapes unscathed. Countries with close economic ties to the United States face direct impacts. Canada and Mexico, deeply integrated through trade, would see demand for their exports collapse. Their economies would slide into recession, and currency values would fluctuate wildly as capital flows reverse. Emerging markets would experience severe stress. Many developing countries borrow in dollars, so when the dollar's value becomes unstable and United States interest rates spike, their debt service costs balloon. Some would face balance of payments crises, unable to obtain the foreign currency needed for imports or debt payments. European and Asian banks holding United States assets would report significant losses. Some might need government bailouts. The European Central Bank and Bank of Japan would face crisis management challenges while also dealing with reduced global trade and growth. Commodity prices would likely crash. When the global economy contracts, demand for oil, metals, and agricultural products falls. Countries dependent on commodity exports, including Russia, Brazil, Middle Eastern oil producers, and African mineral exporters, would see government revenues plummet. Supply chains would face disruption. International trade would contract, not just because of reduced demand, but because financial system dysfunction would make it harder to arrange trade finance and payments. Companies that depend on global supply networks would struggle. Political instability could emerge in vulnerable countries. Economic crisis often triggers social unrest. Governments facing angry populations might turn authoritarian to control dissent, or they might collapse entirely, creating power vacuums. History offers sobering examples. The 1997 Asian financial crisis spread from Thailand across the region, toppling governments and causing immense hardship. The 2008 global financial crisis, which started with United States housing, affected the entire world for years. A crisis centered on United States Treasury markets would likely be worse because Treasuries are even more foundational to global finance than housing debt was. International institutions like IMF and World Bank would be overwhelmed by requests for assistance. Their resources, while substantial, are not infinite. Some countries would not receive adequate help. We might see the formation of alternative economic blocs, groups of countries trying to insulate themselves from dollar system chaos by creating regional arrangements. While potentially stabilizing in the long run, the transition period would be chaotic and contentious. The speed of events matters enormously. A gradual shift over 5 or 10 years would be challenging but manageable. Foreign holdings could decline slowly as central banks reallocate reserves. The United States government would have time to adjust fiscal policy, reducing deficits and making debt more sustainable. Domestic investors, including American households, institutions, and the Federal Reserve, could gradually replace foreign demand. Interest rates would rise, but incrementally. The economy would adjust through slower growth rather than collapse. A rapid shift over months would be catastrophic. If foreign investors suddenly dumped trillions of dollars in bonds, market mechanisms could not cope. The system would experience cardiac arrest rather than slow decline. Emergency measures would be necessary, but they might prove insufficient. The economic and social costs would be staggering. The most likely scenario probably falls somewhere between these extremes, a moderate pace of change punctuated by acute moments of stress. Foreign holdings might decline steadily, then accelerate during a crisis, then stabilize temporarily before declining again. Warning signs would emerge before the worst effects materialize. Treasury auction results would weaken, with lower demand and higher yields needed to attract buyers. Foreign central bank reports would show declining dollar reserve percentages. Financial media would discuss these trends, potentially triggering anticipatory reactions that accelerate the problem. The challenge for policymakers is acting preemptively. Political systems are not good at imposing pain today to prevent worse pain tomorrow. Deficit reduction requires unpopular choices. Politicians face electoral consequences for tough decisions. So even when experts warn about unsustainable debt trajectories, the incentive is to postpone hard choices. This means action often comes too late, after crisis has already begun. At that point, options are limited and all painful. The word to remember here is crisis. For most people, macroeconomic crises feel overwhelming and beyond control. In many ways, they are. You cannot personally prevent foreign investors from selling treasuries, but you can take steps to protect yourself and your family. Financial preparedness means holding diverse assets. Do not concentrate everything in one investment type or currency. Some allocation to international stocks, commodities, or real estate can provide useful diversification if dollar-denominated assets suffer. Debt management becomes crucial. In a high-interest rate environment, variable rate debt turns dangerous. Locking in fixed-rate mortgages or loans when rates are lower provides security. Carrying less debt overall reduces vulnerability. Emergency savings gain importance. Having several months of expenses in accessible accounts creates a cushion if unemployment rises or income becomes uncertain. Even in inflationary environments, liquidity matters for navigating disruption. Preparedness like this builds resilience. Skills and adaptability offer long-term security. Economic restructuring means some industries contract while others emerge. People who can learn new skills and shift careers fare better than those dependent on declining sectors. Understanding these dynamics helps you interpret news and make informed decisions. When you hear about rising deficits or changing foreign reserve patterns, you will recognize the implications and can adjust your financial strategy accordingly rather than being caught off guard. Political engagement matters too. Voters who understand fiscal sustainability and its importance can support candidates and policies that address these challenges before they become crises. Democratic societies get the government they demand. If voters prioritize sound fiscal management, politicians will respond. This entire scenario reveals something fundamental about modern financial systems. They are built on confidence and trust more than on tangible assets. Money itself is largely an abstraction. Dollars are not backed by gold or anything physical. They are valuable because people believe they are valuable and because the government enforces their use for taxes and debts. Treasury bonds are promises to repay in that same abstract money. When confidence cracks, abstractions can evaporate quickly. The housing bubble burst when people realized home prices could not rise forever. Bank runs happen when depositors lose faith in a bank's solvency. Currency collapses occur when citizens stop trusting their money's value. The United States Treasury market has enjoyed extraordinary confidence for generations. That confidence is an asset more valuable than any specific policy or institution. But confidence, once lost, is extremely difficult to rebuild. Complex systems have a deceptive quality. They appear stable until suddenly they are not. Small stresses get absorbed easily, creating an illusion of robustness. Then one additional stress, perhaps not even a large one, can trigger cascading failures. The system reorganizes into a new, often worse, equilibrium. Economists call this phase transition, borrowing from physics. Water seems stable as you cool it, then suddenly, at a specific temperature, it freezes. Financial systems can behave this way. Long stretches of stability, and then sudden crisis. This does not mean a crisis is inevitable or imminent. It means the possibility exists, and the system contains vulnerabilities that could, under certain conditions, activate catastrophically. The scenario we have explored, foreign investors abandoning United States Treasuries, raises a profound question about America's fiscal path and the global economic order. Can the current trajectory continue indefinitely? Can the United States keep running trillion-dollar deficits while debt accumulates? Can foreign investors keep absorbing that debt in the quantities required? The honest answer is no, not forever. At some point, something will force adjustment. The question is whether that adjustment comes through gradual, managed change or through crisis and chaos. History suggests nations rarely choose the hard path voluntarily. They wait until crisis forces their hand. The hope is that this time might be different, that leaders demonstrate foresight and courage to address fiscal imbalances before they become catastrophic. But hope is not a strategy. The Treasury market will not make tomorrow's headlines unless it is breaking news. Yet it is the foundation everything else stands on. If that foundation cracks, the edifice built on it cannot stand. The world has not stopped lending to the United States yet. Foreign investors still show up to Treasury auctions. The system still functions. But the warning signs exist for those willing to see them. Whether we heed those warnings or ignore them will determine whether the coming decades bring gradual adjustment and adaptation or crisis and collapse. The choice ultimately belongs to all of us, as voters, citizens, and participants in this interconnected global economy. The question is not whether the world could stop lending to the United States. The question is, what are we doing to make sure it does not need to?